Hi guys, me and my partner will discuss to you the chapter 9, which is the capital budgeting and the cash flow analysis. So in this chapter, we will discuss about the capital budgeting and the cash flow analysis, in which it deals the the financial management of the assets on a firm balance sheet. So without further ado, let's talk about what is the capital budgeting. So capital budgeting is the process of planning for purchases of assets whose useful lives are expected to continue beyond a year. It is also known as investment appraisal. It is a financial management tool you can use to measure a project's potential, risk, and expected long-term return of investments. Because companies have limited amount of resources and capital to put toward new projects, they must carefully consider the capital investment of a project requires the amount of value they expect to receive from the project to determine whether it is worth pursuing. So, why is capital budgeting important? Ganon siyang importante ni Kaajo. So, capital budgeting is an important financial management tool because it provides a means for evaluating and measuring a project's value throughout the life of a project. Using this capital budgeting is important when you need to assess the rank and the value of a projects or investments that require a large capital investment to determine whether they are worth pursuing. For example, investor can use capital budgeting to analyze investment using the option and decide which one are worth investing in. So, ingani ka importante ang capital budgeting. Kaya ang investor mo gamit sa capital and budgeting para ma-analyze siya nga ang kanang investment worth investing in. So what is capital? So capital budgeting is also important to a company's financial decision makers because it helps them make informed financial decision for project they expect to last a year or more than required a large capital investment. So our ingon a capital budget is a long-term asset or investment. So such project can include investing in new equipment, technology and buildings, upgrading and maintaining existing equipment and technology, completing renovation projects on existing buildings, expanding the workforce, developing new products, expanding into new markets. So types of investment projects. There are three types, which is the growth opportunities, cost reduction opportunities required to meet legal requirements. And the lastly is the required to meet health and safety standards. Next is how projects are classified. There are three types on how projects are classified, which is the independent. Independent is acceptance or rejection has no effect on the other projects. So ang mudawat sa project or i-reject pero wa di na siya makapekto sa ubang project. So mutual exclusive. So acceptance of one automatically rejects the other, which is the replace versus repair. Contingent. Contingent is the acceptance of one project is dependent upon the selection of another. Next is the cost of capital. What is this? Cost of capital. It is the firm overall cost of funds offered, often referred to WACC or the weighted average cost of capital, which is the equal to a weighted average of the investors' required rates of return. This is the discount rate used to analyze capital budgeting proposal. Next is the optimal capital budget, which to expand output until marginal revenue equals marginal cost. Next is to invest. Invest in the most profitable project first. Next is to continue. Continue accepting project as long as the rate of return exceeds the marginal cost of capital, which is the MCC. So this is the optimal capital budget chart, which is the makita diri ang rate, the marginal cost capital, then a project return, then a funding available, cost exceeds return in a fund these projects. So next is the capital budgeting problems. Muna sa mga problemas when it terms to capital budgeting. So first is the all projects may not be known at one time. Next is changing markets, technology, and corporate strategies can quickly make current projects obsolete and make new ones profitable. Difficulty in determining the behavior or marginal cost of capital, which the MCC. Estimates of project cash flow have varying degrees of uncertainties. This is the capital steps or process. First is generate proposals. Step 2 is the estimate the cash flows. Step 3 is the evaluate alternatives and selects projects. Step 4 is the review prior decision. So estimating cash flows. So estimating cash flow is this is how to calculate only the incremental cash flows. Measure on after-tax basis. All indirect effects should be included. Sunk cost should not be considered. Value resources should be measured in terms of their opportunity cost rather than their actual cost. So this is a capital budgeting decision. First, this is the capital decision involves 6 steps. So first is the calculate initial investment. Next is the calculate present value or the PB of the annual after-tax cash flows are attributable to the new assets. Next is the calculate the present value of a tax shield due to capital cost allowance, which is the CCA. So calculate the present value of the salvage value. Next is the calculate present value of the tax shield lost due to salvage. So number 6 is the calculate present value of any changes in working capital. So that's all for my part. My partner will discuss more about the capital budgeting decision or the steps on how to calculate the capital budgeting. Thank you for listening.